have come here to chew bubblegum and kick ass. And I'm all out of bubblegum.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. It's going to be a splash of everything today, a virtual potpourri of real estate news. So stay with us. I think we've got a lot of interesting things. I don't know if we'll make it through all of the stuff I have on the slate for today. There's an awful lot. But there was enough. I had enough little tidbit things sort of on the list that I thought made good sense to cover. It might spread us a little thin across the show, but I think it'll be good info for all of you. Of course, I always like to remind everyone the best way to get in touch with me is through the website at therebelbroker.com. From there, you can send along any ideas, suggestions, observations, or questions that you might have. Just click the contact button in the menu bar. From there, you can send it along. Happy to get it. I also teased on Tuesday's show some new things that are going to come along for folks that are members of the Rebel Underground. I've as I said then, I really want to kind of up the game in terms of the value proposition for folks who've gone to that extra trouble to jump into the group and by doing so, indicating to me they want more. And I have really not been doing that. I've always sort of erred on this side of, whenever I join something like that, I just don't want to get stuff in my inbox every single day. I don't want someone pinging me to buy this, that, or the other thing. And I'm never going to do that. But it made me realize, you've reached out. You've said, hey, Robert, I wouldn't mind getting more from you outside of just the show. So I need to kind of overcome that idea of not wanting to be one of those folks who really abuses the trust that you give me when you share with me your contact information, to the point where I just use it for stuff that I think would be relevant to you. So look for more on that there. And I know we've been talking about changes to that group for a little while in terms of other things. There's videos that I'm currently working on, but I'm going to up the game a little bit so that there's offerings to you that will only be available to folks in the Rebel Underground. So if you're interested in that, please head on over to the website. Again, you can do it at therebelbroker.com. Check the show notes for just about any show, and there will be a link to join the Rebel Underground. And of course, while you're there, I always appreciate folks who take a few minutes out to take the survey to support the show. This is completely different from the Rebel Underground, but it's a big red button at the top of the page titled "Take the Survey to Support the Show," and that's exactly what you're doing. You're providing some demographic information so that folks get an idea of the type of folks who listen to the show. And for doing that, I have been handing out a $50 Amazon gift card each month to a randomly selected person who's gone to the trouble of filling out that survey. So good luck to those of you who have not yet won, and thank you to those who have submitted, and congrats to the folks who have won. Okay, so let's jump in. We've got a few right off the bat, and I always, whenever I am not right, I like to circle the wagons on that for a second and acknowledge it, because almost the exact opposite of what I expected happened in the month of October. Here we are. Today is November 2nd, so we've made it through October. And to sort of remind everyone, my feeling was that we would look back on this October that we just went through as that first moment when things started to crumble, when the stock market started to adjust and go down. And we've talked a lot about why that's a big deal. We've talked about the stress that puts on pensions and how that would require more actions to be taken in terms of printing money. There's a whole lot of other things involved with it. So having the stock market not crash was a good thing in terms of it not happening. Doesn't mean it's not going to happen, but it absolutely means, since we're now past the month of October, that I did not call it. It didn't. We did. And as the folks at Zero Hedge point out through their article, in spectacular fashion, I was wrong. The article headline is, it's official, October was the calmest stock market month ever. So I expected there to be the beginnings of a decline, didn't happen. And in terms of turbulence, history shows October to be the most volatile month for the S&P 500, right? So that's why I picked it. I thought, we've got all these other things that are playing into the market. If it's going to happen, October felt like a prime time for it to happen. But as this article points out, as traders commemorated the 30th anniversary of Black Monday, amid the rising uncertainty of U.S. tax reform, European sedition, Mideast tensions, ongoing Asian saber rattling, and global monetary policy hawkishness, U.S. equity markets experienced the quietest month in their history, despite historically being the most volatile month of the year. The good news is you should always be willing to look at the data and move on from there, right? And when you're wrong, acknowledge that you're wrong. Was it a reasonable thing to project? Yeah, I think it was, given the fact that, as this article points out, October tends to be an already volatile time period. It's the beginning of the third quarter of the year. When businesses are going to do funky things, they tend to do it at that time of year, just before the end of the calendar year, or just before either just before the end of the third quarter or just at the beginning of the fourth, which I think feeds that stuff. But it didn't happen for whatever reason. I don't know why. I'm reading around trying to figure out why the volatility was so low. Because I'm hoping maybe I can draw some other intelligent conclusions out of that. All the other factors we talked about that point to a decline are still there. So that's all still a real thing. But right now, my estimation on timing, I think, is just not on cue. It's the fact that we got through October without any substantial downturns or any other warning lights shows that and if you were going to count on the usually toughest month of the year in 2017 to show some weakness in the market, and that just simply didn't happen, that we need to sort of recalibrate and figure out what's going on. On the good side, that means I have accidentally potentially benefited from the delay in the sale of my own personal property. And we can talk about that a little bit more. Now, for those of you who want to get the details of these articles, there's actually some interesting charts and stuff relating to this stuff about October. Those will all be in the show notes for today's show, so make sure to check those out. You can find the show notes at therebelbroker.com. There will also be links in the show notes that are included within iTunes. I don't think they're tappable, though. I think when you have a URL in there, I think it just goes as normal text, so you wouldn't be able to easily get to it. So probably going to the website's the easiest way to do it. One other little tidbit of news today that I think is always important to point out, because so often these sites that put out information on what's going on with the marketplace kind of miss the point. So the headline, and this is really what most people just read, and this is from CNBC. Weekly mortgage applications fall 2.6% as rates move even higher. Okay, so that implies that the reason why mortgage applications have fallen is because the rates have moved higher. Couldn't be less true. I've told you this before. We are nowhere near the point where interest rates are going to be the main reason why more or less loans are underwritten. It is simply not. Interest rates are not the limiting factor. Now, some of the bullet points that they lay out in this article from CNBC, which again is linked in the show notes for today's show. Interest rates on home loans moved higher again last week, causing both home buyers and homeowners to back away from the mortgage market. That would absolutely be true of the refi market, totally not true of the buyer's market. 100%, not even a little, affecting the home buyer market. We can get into a little bit more detail of why that's true. Total mortgage application volume fell 2.6% for the week on a seasonally adjusted basis. Refinance volume is 38% lower than the same week 1 year ago when interest rates were lower. So the only thing you can take away from this, which doesn't, from the standpoint of us as either market watchers, real estate watchers, or investors, or future buyers, folks who are trying to maybe get a little bit better feel for the markets, trying to get a sense of when the right time to buy is, or just sellers, or you're looking to refinance because you want to pull some money out to potentially take that money and use it in a real estate investment, however you're working through. Only refinance is the thing that is potentially feeding this. The two elements that would be on a very minor level would be interest rates being higher, but only affecting refinance. And the only reason why mortgage originations, not refinances, are lower is a factor of supply. Nothing to do with interest rates. I don't know anyone backing away from trying to buy because interest rates are where they are. It is completely and totally a factor of volume. And if you just go look at the inventory, and the only two numbers you need to know are how fast are homes selling and are they selling for on average over asking price? And in my market, they're still selling for over asking price. Demand still way outstrips supply. My understanding is that's true in most of the other larger metro markets. It just, this idea that they keep selling this line that somehow interest rates have to do with it or interest rates are the thing just boggles my mind. Because it just, all you have to do is look at the very most basic data and realize it has nothing, at this point, it has absolutely nothing to do with interest rates. Now, there could absolutely be a time when interest rates are playing a much larger role in whether or not people are willing to buy, but it ain't today. Now, as I read this article, it is 7 hours old. If you go and look at rates right now, everything remains below, except for the jumbo 30-year fixed. Everything remains below 3%. Not anywhere near the 52-week high, unless you're talking about the 5/1 adjustable rate mortgage, which is up real close to its 52-week high, so the 1 year high. Jumbo 30-year fixed is at 4.18, but still only at about the midpoint between the 52-week low and high. The FHA 30-year fixed is actually in the lower half of the range over the last 52 weeks. The 15-year fixed rate mortgage is a little bit higher than the halfway point at 3.3% for the 52-week range. And the 30-year fixed rate mortgage is currently at 3.99, right at the 50% mark between its highest and lowest points over the last 52 weeks. And this always scares me when I see this. Whenever I start to see news outlets really emphasizing that, right? Because when you look at it in its context, you're like, oh, well, okay, well, it's nowhere near the highest it was even over the last year. So what's the big deal? And if that's true, how would you explain all the times where there's been more sales volume when it was at its higher point? I mean, over the last 52 weeks, the 30-year fixed rate mortgage has gone up to 4.39%. And we were having this exact same freaking conversation then because there was no problem relating to financing. Homes were selling. Homes continue to sell with multiple offers. So your limiting factor has nothing to do with the interest rates. And what's scary is whenever I start to see more and more headlines that really push this mantra of interest rates are too high, it's really pushing this idea that we need to make loans more affordable or we need to make loans open to less qualified borrowers. And that's what we've been doing for the last 2 years. And we have listed off all the way that's happened over the last year, whether we're talking about 120% loans if you roll your student loan into your mortgage. We've talked about weakening the credit score. We've talked about completely disregarding any judgments against you or any delinquencies relating to medical billing or other things in your credit score, because a relatively small number of them were found to be inaccurate. There's this huge push on every level, 1% down loans, 2% down loans, 3% down loans. There's this huge push to simply make money easier to get in an environment where doing that will only make home prices higher, right? Because imagine if you make it easier for someone who's a subprime borrower to borrow more money, then you increase the competition level at these various points, and they'll max out what they can borrow, and then you'll just see people bidding higher on these homes. You'll increase the number of bidders, which increases the frenzy, which increases the bidding. Not good. It's how we made things go wrong last time. So when we talk about, as we did a few minutes ago, the fundamentals and my thoughts on how I thought we were going to start to see something hit the stock market. So I guess what that shows is don't trust me on when the stock market's going to take a dump or when the stock market's going to go down. But all these other things that we've talked about absolutely are realities that play into the marketplace that we're trying to navigate in terms of real estate. These are all things directly related to real estate. So that stuff is still setting a stage that is very scary and could get tipped over by a lot of different things. I thought that this potential downturn that we would see in October in the stock market would be one of those things that sort of starts those dominoes going. And then that didn't happen. So I'm going to keep an eye out and look for the things that might just do it. Okay. If we look at, let's see, National House Price Index, that's an interesting one because it again contradicts this other story of mortgage applications going down. Now, we're going to talk about that in a second. But before we do, we're going to take a quick break, so don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We are talking about a pretty good range of real estate information. We've talked about how I totally called it wrong on what was going to happen with the stock market in October. We talked about mortgage rates and how so many outlets relating to just news outlets that are talking about the latest drop in mortgage applications is acting as if this has affected home buying, and it hasn't at all. Zero, not at all, at all. We could make it harder to borrow money, and it would have no effect. The only effect you know what? Actually, if we were to make it harder to borrow money, it would actually reduce the pool of buyers, which would make the demand drop, which would tend to balance more with the supply, and we'd probably actually see a more rational normalization in prices. But of course, we're not going to see that because the solution that gets pushed is always, let's figure out a way to hand out more money versus let's figure out a way to make it easier for folks to build more homes. If we simply undid all the crazy regulations and laws that we've put into effect since the year 2000, and I don't think anyone's going to argue that unsafe homes were built in 2000 or that builders weren't pestered enough with regulation in 2000. If we just got rid of all the stuff since then, if we got rid of all the laws that the government created to try to piggyback on the crazy ramp up of property values, if we just got rid of that stuff, I think we would see a ridiculous resurgence in the number of homes to meet this demand. Just my opinion. If you don't agree, I'm perfectly happy to entertain that theory. Feel free to reach out to me through the website and chat about that. Anyway, we're talking about the Case-Shiller numbers for the National House Price Index. And the year-over-year numbers are what we like, right? Those are the ones that you don't have to worry about adjusting for seasonal changes because you're looking at the same month last year as this year. And for the month of August, we had yet another increase, 6.1% year over year in August. That's the monthly home price indices. It's a three-month average of June, July, and August. This release includes prices for 20 individual cities, 2 composite indices for 10 cities and 20 cities, and the monthly national index. So it's a pretty good number in terms of getting a feel for the general move in the marketplace. If you're in one of those heavy metro areas, it's going to be something that's going to be a little bit more reflective. But again, just like with anything else, you're going to want to figure out what these numbers are in your area. You may see variation. And even in areas where you may find a metro area that has, say, had the highest, let's say you've had 8% increase or 10% increase in your metro area, you're still going to be able to find pockets where that's not true, where it's far less, maybe far more. So much of your decision making really needs to be adjusted once you've dialed down to the neighborhood area. And one important thing that we've done here on the show for folks in the Rebel Underground is the first video we put out, the only video so far actually, is one that helps you do that helps you draw down to specific communities in terms of looking at the elements that make for good investment areas. Something you'll probably want to check out if you're a member of the Rebel Underground. You've already gotten access to that. And if you join the Rebel Underground in your Welcome to the Rebel Underground email, you'll get a link that'll take you right to that video if you want to check it out. Okay. Now, just to sort of calibrate you to a little bit of historical data here, the national index is 4.3 above the bubble peak and up 0.5% in August. The national index is up 41% from the post-bubble low set in December of 2011. So we're up there in terms of a lot of these numbers. This is good data to check out. And of course, we're going to have the link to this data in the show notes. So feel free to check that out if you're so inclined. Finally, today, I wanted to talk about another interesting change. We are covering all kinds of changes. And these are things that you should be aware of, no matter what part you're playing in the real estate world, whether you're just interested in real estate data in general. We talked about the change in folks, the baby boomer generation, the folks that tend to be 50, 55 or older. Instead of downsizing their homes when they've sort of reached that point in life where I guess we call them empty nesters, their children have moved on and have gone off to college or moved out or done whatever it is they're going to do. Instead of now selling, and then buying a smaller home or that retirement home in Florida or moving to wherever, that dream location or Phoenix or wherever, right? The thing that I think stereotypically we think of folks at that point in their life, what we've got is a gigantic increase, like nearly a 30% increase in the number of those folks who instead are selling their home and then renting. And they're renting apartment-style homes, condo-style homes in suburban areas. So it's not as much of an urban thing. It still happened. We're still seeing a dramatic increase in the number of these folks doing that in the urban area. Excuse me, but not nearly as much as we're seeing doing it in suburban areas. So it's kind of an interesting contradiction there, as we discussed last time, simply because so many of those style of buildings have been built in the urban environments rather than the suburban. At least that's been true in my area. May not be true in yours. But what we need to understand is the opportunities that presents. And here's another thing that potentially shifts an awful lot of things. And this is a number that is something the folks out there who are real estate agents or real estate brokers should be aware of. This is, folks, if you're out there doing your own independent farming. And if you're not doing your own independent farming for your next investment property, you probably should consider doing it. If you've been listening to the interviews we've been doing, one of the common threads among all the successful investors is they're not tending to find their best deals on the MLS. Now, can they find them? Sure. I'm not suggesting you ignore the MLS. I'm suggesting you augment what you're doing on the MLS, because from what we're hearing from the experts, the best way to go here is to try to reach out directly to folks who potentially might want to sell their property. So that means reaching out directly. That equals getting mailing lists. And one of the criteria is, how long ago did someone buy the property? Now, conventional wisdom over the years I've been doing real estate has been, it varies, but 3 to 5 years, 4 to 6 years, those types of numbers in terms of the time between purchase and then considering selling again, right? I know tons of folks back in the good old days before internet stuff and emails were the most common way to communicate. If you sent out letters, that was what you keyed off of. You keyed off of how long ago did they purchase, and they always kept that window that these folks had bought the home at least 3 years ago, right? So that was kind of the main thing. What's interesting is that the average owner now stays in their home, and we've been discussing this sort of anecdotally for a long time. There have been surveys where the confidence levels or the tendency levels of folks who've been getting surveyed has borne this out. But this is the first time I've seen everyone put an exact number on it. Up till this point, we've said things like folks are delaying their sale longer, right? We've been living through that for the past few years, where we've been saying folks simply are not putting their homes on the market at the rate they used to at the typical time. So now the new number coming from this report is that the average owner stays put in their home for 10 years. Big jump from the old days. And it could very reasonably reflect a needed shift in the marketing that you're doing. Or at least it may indicate that you would want to think about, who do those folks look like? It may mean you want to do an entirely different kind of approach with those folks who've been in their property for greater than, say, 7, 8, 9 years, in order to reach out for folks that might have that property that could be your next investment. Now, remember, this is going to be a number that relates to single family residentials. This is not a strategy. You shouldn't be looking for folks who've owned that duplex for 10 years, right? Particularly if the mailing address for the tax bill for that property isn't the same address as one of the two of the duplexes, right? Totally different strategies. For me personally, if just because we're kind of on that topic of what the right strategy should be, if you are looking for off-market opportunities, and again, we've talked about this before, and it's been reinforced by others, those are going to be some of the best deals you're potentially going to find. I usually will simply do I think you have the highest probability with the ones where the mailing address for the owner is different from the duplex. So if I personally was going to market, I would get a hold of that list. And usually you can get a list like that. There's a lot of different places. There's online places you can get it. In the past, I've gotten it from escrow firms, title companies. Not sure if they'll do that for everybody. They'll, as a real estate person who does business with them regularly, there's different services they offer relating to that stuff based on the idea I'm going to bring escrows, right, to that title company. I don't know if as an investor you could walk in and establish the same kind of relationship. Maybe you could. But again, you have multiple avenues. Don't think you can't get this list because you don't have a relationship with a title company. There's absolutely places you can go online to get it. In fact, the United States Postal Service has a great tool for you to go and really drill down on the demographics of the folks that you're mailing to. But in any event, what you're going to be looking for are multi-units. If you're going to do the multi-unit thing, so in a duplex or higher, you may want to limit yourself to 4 units or less, just so that you don't get up to that 5-unit point where things sort of change in terms of management. But find those where the person is not resident in the unit. And I think the best results folks I know have gotten are when they've driven and seen these places and noticed deferred maintenance that would be common to the unit. Things where it may need a new roof, or the landscaping, it looks like it hasn't been getting done. Those kinds of things, when you don't treat your property very well, your tenants tend to feed off of that and tend to then not treat their units so great. So it may be an opportunity for you to find a potential seller who's kind of reached that end of the line point where they're not really interested in investing any more resources into it, and you could potentially get that good deal on a multi-unit property. But for those of you who are interested in really focusing on the single-family residential experience, that's where you want to really be, then this is a big piece of data for you. Homeowners continue to delay moving as the typical seller in 2017 had stayed in his or her home for 10 years before selling. A tie for the record tenure set in 2014, according to the National Association of Realtors' 2017 profile of home buyers and sellers. As we've talked about here, homeowner tenure has steadily increased since 2009, when sellers typically lived in their home for a median of 6 years. Economists speculate that low inventory and soaring home prices are forcing homeowners to stay put longer. Instead, they are choosing to renovate their current homes rather than trade up. What's interesting is I think a lot of this is not necessarily that equation. I think a lot of this is also those folks who would be in the situation of trading down and not wanting to kind of face that. Good news is that homeowners are accruing more equity. The typical seller saw a gain of $47,500 this year, according to the National Association of Realtors report. The longer the homeowner was in the home, the more equity they tended to have. Homes sold after 21 years of ownership saw the largest equity gain at 104%, while homes sold after 6 or 7 years of home ownership saw a 27% return, according to the report. All right, so keep that in mind. Again, as I said, there will be a link to that data if you want to check it out. I think this is great stuff to know because these are the folks you're trying to get at. These are the folks that you're trying to reach and hopefully make a deal with, whether you are a direct investor and you just want to reach out to these people, or you're a real estate person and you're trying to find out who you should be reaching out to for the highest return on investment of your time in terms of folks that you want to talk to. All right, folks. I hope that this has been some useful information for you. As always, the goal is to leave more value right here on the table for you than you've invested in time. Hope we've delivered on that today. Thanks again for listening. I'll talk to y'all next time.